Marcus put in 60,000 hours. 60,000 hours watching charts, learning patterns, hunting moves, living and breathing the market. He finished last. The woman who beat him barely opened the app. I'm Ben, and that number, 60,000 hours, is the one I can't get out of my head. By the end of this video, you'll never look at a trading app the same way. Let me introduce you to 3 people. I promise you know at least one of them. All 30 years old, all earning $75,000 a year. Same city, same tax bracket, same starting balance. 0. Every month for 30 years, $1,000 into the market. $360,000 total. The only difference is what they do with it. Marcus is going to beat the market. Candlestick patterns, pre-market prep, in and out every single day. Sitting still feels like leaving money on the table. He's not investing, he's competing. He's convinced he's winning. For a while, he's not even wrong. Jake is the calmer version. Swing trader. Holds for a few days, sometimes weeks, not glued to a screen, but checking charts most evenings, telling himself he's got the patience Marcus doesn't. He thinks the calmer version is the smart version. We'll get to that. Zoe buys one low-cost S&P 500 index fund every month. $1,000. No stock picking, no charts, no timing. She buys and she closes the app. At the barbecue, Marcus has the screenshots. Jake has opinions about where oil is heading. Zoe has nothing to say, because I bought the index again isn't a conversation. I've been to that barbecue, more than once. That silence is the strategy. Feelings and math are 2 very different things, and over 30 years, the quiet one is about to expose everything the other 2 believed. For the first couple of years, Marcus looks like the obvious genius. He hits a hot streak. There are weeks he's up 4%, while Jake and Zoe are flat. He screenshots his best days, posts them, talks about his edge, about how he's actually doing something, while his friends just sit there. And here's the uncomfortable truth. He's not wrong. On the measure Marcus checks every night, week versus week, trade versus trade, he is winning. I want to be honest. That feeling is completely real. The problem is, that measure has nothing to do with who retires rich. Zoe's screen shows almost nothing, just a number that ticks up a little, drifts down a little, and grinds higher. Then Marcus has the year that convinces him he's right about everything. The market runs hot. His trades line up. He posts a monster 12 months, beats Jake, beats Zoe, beats the index itself. He starts doing the math on going full-time. This, he decides, is the proof. Then the IRS arrives. Every winning trade Marcus closed that year, taxed as ordinary income, not at the favorable long-term rate, at his full paycheck rate. By the time the dust settles, a big chunk of that monster year has handed itself back in tax. More in the losses that followed. The great year wasn't the beginning of something, it was the high point. And that belief that the good year is repeatable is what keeps Marcus in the chair for the next 28 years. If you're watching this thinking, okay, but I'm not Marcus, I'm more like Jake, the calm one, this part is for you. Jake looks at all of that and feels safe. He's not a day trader. Surely the calmer version is the smart version. It's calmer. It's still losing. Jake trades far less, real advantage. But he's still holding almost everything for under a year, still paying the same tax rate on every win, still trying to time the market. The data on that is just as unforgiving for swing traders as for day traders. Jake bleeds less. He still bleeds. 3 forces. Marcus has no idea any of them exist, neither does his trading app. Here's what's running against him every single year. Every time Marcus has a winning trade, he feels like he's making money, and he is. But on January 1st, the IRS shows up for their share. Marcus earns $75,000 at his job. Every dollar of profit from his trades gets stacked on top, taxed at the same rate as his paycheck. Not the lower rate you get for holding longer, his rate. Roughly $1 in $5 goes straight to the government before any of those gains can compound, every single year. Every time Marcus clicks buy and then sell, something invisible happens. A fraction of a cent here, a fraction there. The price moves a hair before his order fills. On any single trade, nothing. He never notices. But he makes hundreds of trades a year, turning his entire account over 20 times. Those invisible fractions add up to roughly 2% of his money, gone quietly every year before he's made $1. Researchers tracked retail traders across entire national markets for over a decade. Fewer than 1 in 100 made reliable profits after costs. In one country, 97% of people who traded for more than 300 days lost money. Marcus's trading app has never mentioned any of this. Not once. It built its entire business model on Marcus not knowing. I've run this math more times than I'd like to admit. It doesn't change. 30 years. Let's see what they built. For the first 5 years, the three of them look close enough that nobody can tell. Marcus is around 70,000, Jake is around the same, Zoe is at 75. Marcus still has the best stories. It feels like a tie. Year 10. The lines start to separate. Marcus at about 155,000, Jake at 175, Zoe at 190. Marcus is already 40,000 behind the woman who never opened the app, and he has no idea because he's comparing himself to last month, not to Zoe. Year 15. It stops being close. Marcus at 265, Jake at 315, Zoe at 375. Put yourself in Marcus's position for a second. 15 years in. You've been doing this every single day, and the woman who never opened the app is 110,000 ahead of you. You don't even know it. Because you're comparing yourself to last month. Year 20. Zoe has 660,000. Marcus has 400. She has 60% more than the hardest worker of the three. Year 25. Zoe has crossed 1 million, just over 1.1 million. Jake is at 810, Marcus at 580. The woman who never traded has over 500,000 more than the man who watched the market every single day. $500,000. Just let that number land. And there are still 5 years left, with compounding about to do the most violent work of its entire life. 30 years in. All three are 60 years old. All three put in exactly the same money, $360,000. Marcus, the day trader who treated the market like a second career, approximately $800,000. Jake, the swing trader who played it calmer, approximately $1.2 million. Zoe, who bought one index fund and closed the app, approximately $1.8 million. Using a just under 9% average annual return, still well below the historical S&P average, to give this model every benefit of the doubt. Zoe ends up with more than twice what Marcus built, nearly $1 million ahead of him, and Jake, the calm one, the responsible one, ends up $400,000 ahead of Marcus too. 3 different strategies, 3 very different retirements, same money in. We've measured all of this in dollars. But I want to measure it one more way. In the one currency nobody can earn back. Time. Marcus watched the market most of the day, most trading days. Prep in the morning, review at night. Call it 2,000 hours a year. Over 30 years, that's 60,000 hours. That's the equivalent of working a second full-time job, a second entire career for 3 decades. Jake spent far less, a few hundred hours a year, managing positions, watching charts. Over 30 years, around 10,000 hours, 2.5 full working years, gone. Zoe spent about 4 hours a year, a few minutes each month to make her purchase, an occasional glance at the balance. Over the entire 30 years, roughly 120 hours, about 3 working weeks total. 60,000 hours. I keep coming back to that number. That's not a rounding error. That's a life. The man who worked a second career finished last. The woman who spent 3 weeks finished first, with nearly $1 million more. Marcus didn't just lose money chasing the market. He paid for the privilege of losing 60,000 hours of his one life and handed them over for a result worse than doing almost nothing. No return in any year ever pays that back. So here's what I'd actually tell Marcus. Build the core in low-cost index funds. Lower taxes, lower costs, and a record professional fund managers can't beat. S&P's own data, 9 out of 10 active managers fail to outperform a simple index over 15 years. If they can't, the math on Marcus isn't encouraging. If the urge to trade is real, wall it off. 5% of your portfolio, no more, inside a Roth IRA. Short-term gains aren't taxed there. The biggest single leak in Marcus's strategy disappears. The other 95% stays boring. That's the architecture. And use the right scoreboard. Your returns against the index, not your best week. Your time as a real cost. Hundreds of hours to underperform something you could buy in 10 seconds isn't a hobby. It's an expensive job you're paying to do. Marcus felt like he was winning every single week. The feeling was completely real. The wealth wasn't. The market doesn't pay you for effort. It pays you for patience. That's the Ben factor.